Welcome to Quiver Financial's weekly market report, where we discuss the financial topics that matter most to your portfolio and update you on what we're doing for our clients as markets evolve. Today is April 25th. Happy end of April, folks. At the start of the month, we told you what to look for. Today, I'm going to update you on what happened, what we got right, what we got wrong, but most importantly, what happened this week in the news that matters to your portfolio. Well, of course, tariffs continue to be the number one topic. We've got Bissent and Trump coming out doing a little dance of the duo, doing damage control. Every time, folks, that the 10-year Treasury gets to a certain point, all of a sudden these guys come out and start singing a totally different song than they did a couple days before. So I'm going to give you a little fresh perspective on tariffs and something that you're probably not going to hear on channel 247, CNN, Newsmax, or Fox. So this is going to be really important for you to understand what's going on with tariffs and how they're going to affect your pocketbook. Interest rates. What row? We showed you last week that interest rates were testing, the Trump administration testing markets. The reason the cover of this show had the big dog, because the big dog wagging markets, stocks, gold, bonds, is interest rates. I'm going to show you why 4.25 to 4.35 in the 10-year Treasury is what either keeps the wheels on the bus rolling or the wheels come off. So you got to see this. This is probably the most important thing happening in markets. While everybody's looking at the stock market, you really should be looking at the 10-year Treasury. I'm going to show you why. Stocks. Last week, we showed you that the market closed right on an inflection point, a very important trend line that goes back over the last 3 years. We got a great bounce off of that this week. Is it a dead cat bounce? Is it going to give it up and go back to the lows? And I'm going to show you some green shoots. There's some things I'm seeing in the market that is encouraging, and next week's going to really be the tell of whether you can be back to buying this market or if you have to continue to be on the sidelines. Gold, we showed you last week that gold was making a parabolic move higher. It's made a pivot from that all-time high, pivot lower, that is. So we're going to talk about buy, sell, hold, also why silver may be a better point of entry if you're looking to get into the metals. So if you've been thinking about gold, if you own gold, you're thinking about buying gold, anything of your thoughts about gold, you've got to see this, because I'm going to break down what to look for in the short term, intermediate term, and the long term, whether you're a trader or an investor in gold. And boy, oh boy, the whole show really is about, is it time to buy or bail? Every one of these markets this week is at an inflection point. Next week is a huge, huge tell. I can't wait to do next week's show. I think there's going to be some huge developments with whether we can tell you that this decline in the market was a buy event or just the beginning of a really bad bear market. So let's get into this week and talk about the number one topic that's been there for weeks and weeks and weeks and weeks. We've talked about it before, tariffs. So what's a fresh perspective on tariffs, right here? Don't Google that. You get all kinds of weird things, okay? So if any of you remember 1997, there was a movie. Robert De Niro was in it, and the movie was called Wag the Dog. Again, why the title of the show today is interest rates wagging the market, because this show was great. This movie, if you haven't seen it, watch it this weekend. This movie came out before social media. This was 1997. It was before, talk about established media had been around. All of us were watching 247. Maybe somebody was watching some cable news like Fox or CNN back then. The show was really a commentary, because one of the characters gets in trouble. He's a politician, and he has to spin his way. He gets in trouble with the president's daughter, nonetheless. And he has to spin his way out of this, and he hires a guy to create a complete fake war with Albania. I mean, this thing was complete with footage of the war, the whole thing. The movie's funny, dark, everything, but it really was kind of a political diatribe, a conversation about how easily all of us, whatever country you're in, United States, China, wherever, all of us as humans, because of our herding mentality, that we are so easily influenced by the media. And if you want to know what's going on in tariffs as you're watching the media, all you got to know is that probably 90% of what you're hearing is completely wrong. If you hear them saying, hey, you know what? We got to deal with China. We're talking with China. We're not talking with China. All you've got to do is look at the other countries that we have a good relationship with. And one thing that wasn't talked about in the press today or this week is that we've been working hard with a deal with Japan. And we haven't been able to get a deal done with Japan. Walked away from the table because they weren't willing to agree to some of the constraints that we were placing on our tariff regime that would basically box out China. So you saw last week, China said, hey, if any countries try and do any tariffs with the US that boxes us out, we're going to look at that as not that great, right? So here we have a situation where Japan, who we're very friendly with, right? We have a lot of trade, a lot of need for them. They have a lot of need for us. And we can't get a deal done with them and realize we got 90 days. We can't get a deal with them yet, let alone anybody else so far. So all this stuff around tariffs and what you hear is this a long, long phase. So I'd like to rephrase a little bit of what I said in February about tariffs because I said they'd be temporary. Well, this is going to be more like when we got into inflation and they said it's going to be transitory. Well, temporary might be 5 years, right? 4 years, however long this administration may last. Okay. So they might be temporary, but temporary may be an extended period of time. And everybody should probably start to wrap their head around that because trade deals, when you're friendly with countries, take years to get done, let alone in the current situation. If you want evidence that Wag the Dog is happening right now, then let me tell you this. Here we are, April 25th, today. Trump insists bond market tumult didn't influence his tariff pause. I wasn't worried. April 9th, the day that they came out and said, we're going to pause the tariffs for 90 days. I watched the interview. Bond market now is beautiful, Trump says. Did you see the bond market? It's now beautiful. Okay, so whether they're on the right, they're on the left, they're in the middle, they're going to lie to you. Politicians, CEOs, how do you know they're lying? Their lips are moving. All right. So, Wag the Dog is happening. Please watch the media. Do not let it get your emotions riled up because realize a lot of what you're seeing is just smoke, mirrors, and noise. So, let's talk about what matters. Interest rates. Okay. Everybody's looking at the stock market, but interest rates are the thing that's influencing. If there's a dog in this market, if there's a big dog like Barkley wagging the performance of stocks, real estate, bonds, and the economy, it's interest rates, specifically the 10-year. Because if you think about tariffs and you think about what trends they influence most, whether they're short-term trends, intermediate-term trends, or long-term trends, tariffs are things that take a long time to negotiate, and then they usually need to be set in stone for a period of a long time. So they're probably not going to affect too much of the short-term rates except for now, or short-term interactions in the market except for now when there's a lot of uncertainty. Most of the time, the results of tariffs are going to have more of an effect in the longer-term trends. Now, what is that? Long-term trends is 5 years or more. Intermediate term trends say 1 to 5 years, short-term trends less than a year. Currencies like the dollar yen, which is very, very important, and I'm going to talk about next week quite a bit. Currency trends between dollar euro, dollar and China. Those currency trends will go over many, 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 many years because they're also intertwined with what happens in interest rates. So today, I'm going to spend a lot of time right now speaking about what's going on in the 10-year Treasury market and why next week, whether it gets above 4.35% or below 4.25%, whether that keeps the wheels of this market rally on, this bounce in the stocks that started this week, does it continue or does it fail? I think it really centers around the 10-year. So let's give that a little bit of love, like Barkley's getting from the cat here. Dog's amazing. I've never seen a dog make friends with cats. It's cool. All right. So we've been talking about that in an interest rate market, because interest rates determine so much in the economy. Everybody does best. The economy, everything does best when the trend in interest rates can be consistent and predictable over 3, 4, 5 years. Typically, that is the case. You can see here in this chart that we made in January of this year, it tracks the 10-year Treasury from 2022 to 2025. And you can see it's been in this disciplined place between 3.5% and let's say 5%. We've called that the Goldilocks zone. If we can stay in that zone, then interest rate sensitives like traded REITs, utilities, and other things, Treasury bonds, will perform well within a portfolio. If you start to get outside of those realms, specifically above 5%, then those investments become detrimental to a portfolio, especially if you're running a 60-40 type of portfolio. So in March, we updated this and said, well, this continues, because realize that last chart was in January. So now, 3 months later, we continue to be in that range between 3.5% and 5%. However, something has been developing that caused me to point out to everybody that these lines, the red dotted line, about 4.5% on the 10-year and about 4% on the 10-year as well, that those lines, 4 to 4.5%, was like the short-term fighting ground. If we could get below 4%, you could possibly see a pretty good rally in things like traded REITs, interest rate sensitive investments, right? Treasuries, ETFs that are related to them. What happened since then is, we spiked below 4.25%, got down almost to 3.75%. It was a heck of a quick move. And then all of a sudden, day before Liberation Day, or actually right after Liberation Day, we spike up to 4.5%. And it's like, what just happened? That move from almost 3.75, so call it 3.8%, up to 4.5% in the matter of 3 days is an unprecedented move in the 10-year. You don't want that kind of volatility for an important part of the market that likes stability. So that's when we pointed out to everybody that now the fighting ground in the 10-year and all other markets is probably between 4.25% and 4.5%. And that's what got Trump to pivot. When we woke up one morning and the 10-year was pushing above 4.5%, that's when they came out and gave the 90-day pause. So like I showed you in the beginning, April 25th, interest rates didn't matter. Well, April 9th, they sure the hell did. So tell me what's true, what's not. So what I can tell you is that the charts lead the news, because we were able to point all this out. And last week we showed you that the concerning thing about the 10-year is when you look at how the price bottomed here and how the RSI, Relative Strength Index, these things, and for novices or for newbies, I don't expect you to see all these circles and things and know what they are. But essentially what you need to know is this type of pattern starts to give you the impression that the path of least resistance for rates is higher, not lower. I hope not. Next week is going to tell us the big tell, okay? So next week's really important in the 10-year, because last week we said 4.3 was what to watch. Here's what happened since then. We pulled back. We got back up to 4.5. Now, as this has been happening, if you think about this week, Monday they came out and said, we're going to play nice with China. Guess what? Where were we around then? Right here, pushing 4.5%. Every single time we get up towards this red dotted line, it's either Bissett or Trump that comes out and starts to soften their tone around China and tariff and trade. This isn't a coincidence. For whatever reason, this is an important level. And that's why I'm saying if we get decidedly above 4.5% in the 10-year, it could be the one thing that disrupts this rally or this market bounce. So that's what's really important to watch next week is what happens between here, the green dotted line and the red dotted line, which is 4.25 on the bottom, 4.35. It looks like on Friday, April 25th, we're closing the market right on that level of support. That's why next week becomes the big tell. So stay tuned because I'm going to really be watching what happens in this relative strength because that'll give me an early tell on whether the trend is higher or lower in the short term. Because where this RSI tilts back up, whether it's above or below 4.25, is going to give me my next sign of what I can tell you guys what to do. Okay. So this is really important to next week. I'll update you as we go through this. What's going to be really, really key is do we pivot back higher above 4.25 or stay below it? What does all this mean for you? Okay. If you're a Quiver client, you're watching, we're making these moves for you. But if you're watching this as an outsider, what does all this mean? It really means that if the 10-year treasury is below 4.25, 4.25%, and can stay below 4.25%, then our 2025 interest rate theme is intact, meaning that you can continue to own interest rate sensitive investments, which are also probably the investments that pay some decent income. However, if we get above 4.5% and we sustain above 4.5%, that significantly threatens the interest rate theme, and lower risk investors may want to avoid rate sensitive investments for a period of time. Obviously, this is not trading or investing advice. I'm not trying to sell you anything here. I'm just telling you that as a money manager managing money for individuals that have a time-sensitive timeline. Hey, they might need their money in 5, 6, 7 years, and they want to avoid losses. These are the lines in the sand that, for me, determine whether I, within their portfolio, can add or subtract interest rate-sensitive investments based on what the market is doing. So I'll update you in the next week. In the meantime, I highly suggest that everybody go out and read our retirement red zone, because I just mentioned to you that analysis I gave you is for people that may need or that are retired and may need use of their funds in the next 5 to 7 years. That's what the Complete Retirement Red Zone package is about. We wrote an article called The Discouragement Trap, How to Dodge the Spiral and Win. It's a little bit of a spin on markets and just emotions, because if this current market morphs into a bear market, a lot of people are going to get discouraged if they're not already. And also, from last summer, I highly suggest we have a Catch the Next Wave part of our blog. So if you go to our blog, check out the yen carry trade issue. It's from the summer of last year. We were talking about the yen carry trade, which is what's really driving a lot of things that's happening in interest rates and currencies. So if you start to hear about that in the news, realize we've got a great resource piece on the website for you. Okay, so equities. Let's jump right into this and wrap this whole thing. We're going to do equities and then stocks and close it up. So last week, we shared with you this longer-term chart of the S&P 500 from 2009 to 2025. We drew a line, what you would call the reversion to the mean line, okay? So this is long-term support. And what you need to know is that markets, when they trade away from this long-term support, they will have a tendency to eventually snap back towards the mean. This is like the balance of life. This is the balance of nature. This is when you realize that markets do have some natural rules to them, which is if things get too parabolic or they get too pulled away from their base, they'll eventually come back and revert to it, okay? Balance. So we also showed to you that there's this uber bull line. Like this started in 2023. And if this current market decline is a buying opportunity and the stock market is going to go back to the old all-time highs or higher, then we would want to see this line hold and any decline. And last week we closed right on it. You can see we dipped below it and then we closed right on it. And this week we've bounced from there. So let me give you an update there. So we said this is the intermediate term support. It's been there for 2 years. Trading above it is great. Trading below it, not so much. So now what I did here is I shortened up this chart to being the last 3 years. What you saw before was the last, call it 15 years. And now this is the last 3 years. And this dotted line is that long-term support. Okay, right there. So that's that. But basically what we've been saying is this is the bull bear dividing line, that if you're above this line, the market trend is still bullish. So the rule book says buy the dips. However, sustained trade, we break below this and stay below it, then the rule book switch from buying the dips to selling the rips. So we haven't closed below it before yet. We've whipsawed it. We played around with it. I told you last week that the early tell line will be how we get to a pack around 5,600. I also mentioned last week that I was concerned on the relative strength because making this type of pattern and low was not a great impression. However, there are some green shoots happening here that have me encouraged. So here's an updated chart. I shrank it down to the last year. There's that long-term or that intermediate term bull bear line, buy the rip or buy the dip or sell the rip. And now what's encouraging is the relative strength this week paused and pivoted back higher while the market bounced right into resistance. So how we close today, and the market isn't closed yet as I'm recording this, and how next week trades is really important because basically that short-term resistance line and that bull bear line, everything that happens in between there is noise. And so we could bounce around there for another week or two, trade back down to 5,300, back up to 5,400, and burn some time. Everything that happens between there, what Trump says, what Brissett says, what anybody says is noise. What really matters is what happens above or below there. So if we can get above that green line, that red line, and sustain trade above that short-term resistance, that's very positive for the market and adds another anecdote. Adds flavor to the conversation of, was this a buyable dip? Okay, and if we do trade above that red resistance line I show you there, call it around 5,500, then you're probably going to hear me start to say, all right, hey, you know what? Some of the dangerous past, higher risk investors, people who are not as time sensitive, maybe they can start to go back into buying the dips. So we'll see after next week. There's some green shoots, like I mentioned, and again, not trading advice, just sharing what I'm seeing out there. This first chart is Google. Google came out with earnings. They had a nice little response to earnings today so far. The green lines that I showed you here, the first one at the very bottom is the relative strength. And I just kind of showed that that's a very constructive building pattern and a stair-stepping higher, while the second green line above that, you can see that price made a low, then another low right here that's a little bit higher, and now has gone off to the races. So is this a buying signal? The real tell, and again, Amazon, same thing, very similar look. Next week will give us the answer because that red dotted line, which looks like is right exactly where we're closing this week, that's the short-term resistance. Anything between the gray and red is just noise. Depending upon your time frame of investing and your risk level, you can do different things within that range. Below the green line is bear market territory. Above the red is, hey, this decline looks like a buying opportunity. Continue to monitor, or if you can handle the risk, maybe you start to dip your toe back in. There again, everybody's situation is different. Talk to your own financial guy before you start buying or selling. So the big question next week will be, can the Mag 7 get above resistance, stay above it? What does it all mean for you guys? Well, bottom line is this. If the S&P 500 is below 5,200, the bears have the ball. And the next target for me to watch is how does the market react and respond to about 4,600. And if the market can get above S&P 500, 5,500, then it looks like the bulls have the ball and bears should be very concerned or should be cautious. And the odds favor that we test the all-time highs, especially if you get above 5,600 is my analysis on this. So next week is really important to watch in the equity markets and the interest rate markets. So far, so good. Very encouraging what we're seeing out there. If you were concerned and scared 2 weeks ago, some of the things that's happened in markets over the last couple of weeks should allow you to feel a little more encouraged. Now, let's wrap things up and close it with gold and metals because there is a trend change happening there. It's a short-term trend change. Don't stress. Don't worry. So last week we showed you that, we zoomed out. This is a longer-term chart of gold over the last 5 years. When you zoom out like this, you can see that it's really gotten parabolic. We showed you the last time that it consolidated and peaked out where the RSI was, and now we're making a new high. RSI looked like it was starting to cap out there. Update this week. We did see a little correction this week, starting on Monday, Tuesday. Gold has started to pull back. RSI has pulled back quite quickly. So this is a small correction in the big scale of things. Is it a buying opportunity? Should you wait? It really depends on what kind of person you are. If you're a trader, okay, if you're a trader and you know how to scalp, which is a very unique few people out there. However, if you're one of those, then you could have this dotted line I drew here, which is like the uber bull parabolic. If gold is still meant to go to 4,000 before getting down to, let's say, 3,000 or 3,200, then it'll hold this line and just power higher. I did this as a dotted line because my belief in that is mediocre. I'm just pointing it out as a possibility. Eventually, what I think is the bigger, probability is gold eventually does correct back down to its mean, reversion to the mean. And whether that happens because equities start to rally back and everybody that was in gold starts to sell it and goes back to the Mag 7, I don't know. If it's because you get a parabolic move that just explodes and comes back down. Nonetheless, I do think within some relative time, gold has to come back and test a larger area of support. So if I was an investor, if I was somebody who was looking to buy gold for the long haul, then I'd be patient. I'd give it some time, let it come into you. Everybody thinks they're long-term investors until they buy something and in the next 2 weeks it goes down, relentlessly. So that long-term support line and reversion to the mean is what I'd be watching if I was wanting to buy gold. I'd also be more interested in silver. Because silver hasn't gotten away from its mean. It tends in these trends, once gold and the gold miners do their thing and they get too expensive, people who feel that they missed the trend will maybe rotate into silver. But in order for silver and silver miners to get above this resistance that they have here, you've got to continue to have probably bad news. And in that bad news, gold, like especially around the tariffs, gold trades sideways and silver gets a bid. So, normally gold and silver have a tandem trade where, gold goes down, silver goes down. There are times late stage cycle like this where one's gone parabolic where they will start to decouple. And that's what I'm watching for and why I sold our gold and held on to our silver as a hope that maybe it'll play some catch up. It's performed well. So what does all this mean? Well, if you're a trader, trade away, but know how to scalp. Like I said before, that green dotted line is your tell. If you're an investor in metals, wait for a pullback to support what we call the mean. And keep an eye on silver. It may be a better relative strength and as well as a risk reward, because at least with silver, if you notice in that chart I showed you, just one here, I'll go back. Um, that green trend line can be really used as risk management. If you were a buyer of silver and you weren't a huge long term believer in it, then you could use this green trend line as your stop loss. Like you buy some and then you have a discipline that if you break below it, you get out of the position, admit that you're wrong. And yeah, you can whipsaw and go back up, but if you're just able to be disciplined, you could do that. So again, that we what are we doing? We took our profits and we're going to relax on the beach for a few weeks. Barkley and I are going to go chill. So next week, I'd love for all of you to join us because I really think it's a good time to talk about why currencies matter and why so few advisors consider them in their analysis. Almost everybody just looks at stocks and bonds. And especially if you do portfolio theory or the 60-40 type of stuff. If you really want to understand what's happening in the bond market and in interest rates and in so many other markets, you got to understand what's going on in the US dollar and in the yen carry trade and things of that nature. So I'm going to give you some inside baseball on that. And most importantly, we're going to update you on stocks and interest rates. I think next week is a really huge tell for the rest of this year and whether the worst is behind us or if we continue to muddle through the mud. Until next week, folks, take care. And you know what? Better yet, take good care of others. Please give us a like and subscribe if you're finding these things helpful. I appreciate all the kind words from the Quiver clients who have been saying these videos are helpful. Until next week, take care and have some fun in the sun.